Welcome. This is CNN Vantage Point. I'm Philip Crow, Chief Investment Strategist with CNN Wealth Management. Today's podcast will provide a market review for the month of September of 2023 and our current outlook. September is a historically weak month for equities, and history repeated this year. The S&P 500 index declined 4.77% during the month. However, the index is still up 13% in 2023, driven primarily by the strong performance of a handful of giant growth companies dubbed the Magnificent Seven. Those are Apple, Microsoft, Nvidia, Amazon, Tesla, Alphabet, and Facebook. Equity performance outside of domestic large companies has been more subdued. The small cap Russell 2000 Value Index declined 5.2% in September and is down 0.58% this year. International equities have also failed to keep pace with the S&P 500 index. The MSCI EAFE and MSCI Emerging Market Indices returned 7.6% and 2% respectively year to date. Higher bond yields also pose a challenge to U.S. equities as rising interest rates increase the appeal of fixed income. The 10-year Treasury yield ended the month at 4.59%, its highest level since 2007. The prospect of yields remaining elevated for longer gained traction following the September Fed meeting. While the Fed made no changes to the Fed funds rate, the updated Summary of Economic Projections, also known as the dot plot, shows just 2 quarter rate cuts in 2024, down from 4 cuts previously projected. Persistent inflation remains a problem for the Federal Reserve and helps to justify the case for rates to remain elevated. Since June, oil prices have risen around 30%, and the Consumer Price Index has reaccelerated to a 3.7% year-over-year increase. Core CPI remains elevated, increasing 4.3% year-over-year. The U.S. dollar has benefited from higher rates and reached its 2023 high in September. Despite the Fed funds rate steadily increasing to its current 5.5% rate, inflation remains above the Fed's 2% target against a backdrop of resilient economic growth. We believe the Fed could be forced to raise rates again by 0.25% at their upcoming November or December meeting, but we do not expect any rate cuts in the first half of 2024. In short, we believe investors need to accept higher rates for the foreseeable future. Higher interest rates have pushed core bond yields to their highest levels in 15 years and provide an attractive entry point for fixed income investing. We added to our core fixed income allocation during an August rebalance that trimmed equities. Our portfolios still retain a neutral equity allocation. Higher yields increase the appeal of fixed income and create higher financing costs for equities, but equities still have tailwinds. Earnings estimates are improving, and this may help provide a floor for equity price declines. Additionally, macro factors such as robust consumer spending and a strong labor market are supportive of equities. Within equities, our portfolios have a slight value tilt and a large company bias as a defensive hedge. I'd like to remind our listeners that market conditions can change quickly as circumstances and facts change. CNN's market views and portfolio positioning may change accordingly. If you'd like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. If you like this podcast, we'd be grateful if you share it with your friends. On behalf of the entire CNN Wealth Management team, I thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.